So I recently met with a really great couple who's retiring this year, and we're setting up their retirement income withdrawal strategy. And one of the accounts that they have that's a part of this strategy is a non-retirement account. And that's a common type of account that people have with either ETFs or funds or stocks inside of it, really any type of investment. And any interest or dividends that are created that year are taxed that year as well. And then if an investment is sold, it's either sold because it went up in value and there's a gain that you pay tax on, or it went down in value and there's a loss that you might be able to write off on your taxes. So in this scenario, a lot of the investments in the account had a long-term gain tied to them. So they bought it for, one individual fund for 50K and now it's worth 100K. So that's great. If they sold it to help fund their retirement income plan, then they'd end up paying 75 to 10K in taxes on that single fund that had appreciated. And if this was done over the course of a few years, then it could really add up to quite a bit that you have to pay in tax. And in retirement, for them, every dollar matters, just like for you, every dollar matters. So implementing a tax saving strategy helps make a big difference in the success of their plan and maybe yours too. But the other key is that they're charitable and they want to continue to give in retirement. So they give between 5 and 10K per year, or they want to in retirement. So usually they're giving out a cash and they give it straight to the charities that they want to give to. In this case, they were given to church. So usually they're taking their cash and having it go straight to church. Now, here's the idea that we thought about. What if rather than give cash, what if instead we looked at that non-retirement account and inside there were all these different funds and ETFs? And let's take this case of the 50K to 100K value. What if you took a portion of that 10K of that highly appreciated asset and gave that to a donor advised fund? Now, donor advised fund, that's something that's can be in your control. It's technically, when you move the money in, it's technically out of your estate, but it's still money that you can designate to go to different charities when you want and how much you want. And some people, a lot of times, will give to multiple charities that they care about, right? And you can decide where it goes as well. For them, the case is, since they're given a lump sum, they still want to give monthly like they used to. So they're going to do a lump sum in, and then they're going to have autopilot send out every month a certain amount to the church, just so the church can better budget as well. So instead of paying $1,500 to $2K in taxes every year, they pay zero tax on that transaction, and they get to give to their donor advised fund, and it's set up on autopilot, and the church gets the same amount that they were going to give. All in all, the only person who gets cut out, I guess, would be Uncle Sam in this scenario, which maybe that's not that bad of an idea. It depends. Everybody has different thoughts there. So this is just one example of how the 5 mini plans make up a much larger retirement plan and how they must work together to see some great success. In this case, it was the income plan, the investment plan, the tax plan, and then also the legacy plan. It's kind of the legacy and charitable plan working together there. So if you like these short videos on retirement specific topics like this or examples, then please subscribe, and then I'll see you in the next video. And also look in the description below, because I put some helpful links down there for you to check out if you're getting close to retirement or you're already in retirement. So I'll see you in the next video, and have a good rest of your day.